Hi, everyone. For those who just logged on, my name is Dominique, and I have the rest of the Greenleaf team here with us today. And today we'll be discussing the Park Hill refinance closing. But first and foremost, Greenleaf hosts weekly live streams and private connect events every Thursday afternoon with a new topic every week highlighting a portion of our business. Private events are more interactive, while live streams are open to the public. So before we dive in, we want to provide you with a quick overview of what to expect this afternoon. As always, we will start off with our rules of engagement. We'll dive into the Park Hill refinance closing, as well as use of proceeds. We'll do a first look of upcoming opportunities, and then we will start our question and answer segment of the broadcast. So to begin, first, you do have the option to change your presentation view. Feel free to switch your presentation view to speaker spotlight, or you can click and drag to make the presentation on the screen bigger or smaller. There will be a Q&A portion at the end of this presentation, but you do not need to wait until the end to submit any questions you may have. You can use the Q&A button located at the bottom of your screen to submit your question, and our team will be sure to answer those. This is a friendly reminder that this live stream is recorded, and we will be sharing that link to the recording by the end of the week this week. Well, without further ado, I will pass it over to our hosts, Dave Kodre and Josh Friedenson.
All right, thank you very much, Dominique. We've got a quick but pretty awesome presentation today on how much money is going out. But to kick things off with, we've got a couple pictures here of Park Hill has lots and lots of kids at it. So we had 213 units. We downsized to 208 units, but we still have at least 100 kids at this complex. So we did a little back to school event here. We got all the kids out and had some water toys, and they had a good time. So
yeah, a lot of you guys probably don't remember, but this property came with basically a big single family house and then kind of a storage warehouse behind. I think the storage warehouse is like 3,000 square feet. The single family house we use as kind of the community office and community center, but the storage warehouse they turned into basically a community event center where I know one of the residents teaches like Zumba classes. There's kind of an after school daycare there. But this is very much a family environment, a family community. We also, Greenleaf has been involved in Gainesville for
wow, so like 13, 14.
Yeah. So we've been the largest affordable housing provider in Gainesville between our apartments and mobile home parks for just short of 10 years now. So very engaged in the community and what's going on up there.
Yeah. All right, so we look at the current deal, kind of what happened. We sent out the notification. We completed the refinance. We have been working on this for a while. We actually got everything signed and closed on Monday of this week. And with that, we were able to secure a new 10-year loan. We utilized Capital One, who we've really done all of our multifamily lending above the $6 million debt level goes to Capital One with Fannie Mae. So we dropped our interest rate from 4.5 to, I actually think it's 3.43%.
Yep. Before we close that, yeah, they guided at 3.49, and then the actual locked rate ended up being 4.3.
And then our new loan is $13,238,000 that we got right now. And it's a 30-year AM, and it has prepayment penalties that are the step down basis. We did a few of the yield maintenance experiments. Those weren't a whole lot of fun. So we don't do any of those anymore. We have these prepaid 5, 5, 5, 5, 5, 5, 4, 4, 5%, 5%, 4%, 4%, steps down all the way to 1% at the end of the year. So end of the term. So we're excited about this, the loan. It allows us to participate in the continued strong rental growth that we're seeing, and also get a lot of cash out in the current time frame. So just to give you a quick idea of where we came from on this deal, this was the third phase. We had 32 units that looked like this. Some people ask us what we do, and they're like, "Oh, are they Class C?" And this is more like Class F. Vacant, no windows. We did everything imaginable to this side of the complex, 32 units. When we bought it, we met with the city, and they had binders of all the code violations. It was like this thick. They're like, "Here you go." I was like, "Well, this is at least helpful. It tells us what we have to do." So that was good. We knocked all of that stuff out, and now we have kind of our financial picture of where we're at today. So we purchased this for $7.5 million. We put 2.3 million of equity into it, and we had this going in loan. And today, as of Monday, and this isn't going to line up with everything that's on our investment cover page and everything. This is based on our current loan. So we had an appraisal, and it came back at $19,350,000. So we're now able to have no cash invested. All of the monies we return to capital, and we'll have about $6 million of value left in the deal. And the life of the deal, we paid out our prefs of $1.16 million. So this is kind of a snapshot of what we took it to in 2015 to where we're at now in 2021. If you have questions on any of these numbers, we're going to go into a lot more numbers. But if you have questions, if you type them in, we can jump back to any of these slides to make sure we cover everything and make sure it's as clear. Josh and I spent hours talking about this stuff, so sometimes we think it's clear, and on the other end, we're not clear. So if you have questions, please type them in here, and we'll make sure we answer them. But we're going to walk through the refinance analysis as a whole.
Yeah, so we're going to go through the refinance analysis, and then the next slide we're going to go through is basically future projection cash flow. So, we think we've kind of covered most of the questions that should come in, but again, please feel free to kind of interrupt my messaging.
We'll see how we do.
Yeah,
we'll see how we do here. It's a little bit of it's a test for us. So when we sent this out, we were projecting about a $13 million loan. We got our final loan for $13,238,000. We paid off our old loan. It was $5.9 million. We had about $470,000 of closing costs. And I know Josh and I are not excited about closing costs any more than anyone else is. But with that, we had about a $90,000 prepayment penalty. We talk about these step down basis. Deal number 14, we had like a $1 million prepayment penalty. So this one was only 90 grand, which it's still 90 grand. That's a whole lot of money. But that was our prearranged prepayment agreement on that previous loan. We've got things like transfer taxes, which is you're paying 1% on, or you're paying 0.5% on every loan that's over 3 years in the state of Georgia. Legal fees, we've got lender fees. So it adds up in surveys, but so we ended up at 469. And then we also, I know we have not had distribution here for the first or second quarter. We had the fire, which we got about $1 million of insurance proceeds for. And we didn't make any distributions because we weren't sure where things were going. So on the books right now, we have almost $860,000 of cash. So right now that gives us a total available cash of $7.7 million. That's where we're at as of Monday with this new loan and the proceeds from it. So the immediate stuff we're doing is returning the existing equity, which is $1.877 million. And we have preferred returns that we have not paid, and these are on the cover page as well. So all of our preferred returns up through the second quarter, and then prorated to when we close the loan. That's an additional $299,000 that will be sent out, and we plan to send all of this return to capital and the press out on Friday, tomorrow. So those will all be coming through Juniper. The next part is $155,000 in holdback, and you want to talk about kind of how that gets figured out kind of at the end?
Yeah, so anytime we finance a property, we have to hire an engineer. Either we hire them or the lender hires them. They do a report, and we've talked about this on Lake Park. We just talked about this on that upcoming deal. But we always talk about kind of our improvement strategy when we buy an asset, but also when we refinance an asset, we have to look to basically kind of make sure that we are keeping the property in a stable condition. The engineer report comes back, and they basically say anything that needs to be done in the first 12 months in the immediate repairs needs to be held back and needs to be basically repaired, and then we can draw against that money as we improve it. So $155,000 roughly repairs. Most of that site work. So either parts of asphalt, there's parts of
sidewalks,
some drainage issues, all kind of a lot of little things that on a roughly 20-acre site that added up to a bigger number. Nothing that we weren't expecting. It's just a lot of little things that we got to work on. Any kind of, like, one of the big things that, especially in the residential world, they look at is trip hazard. So if there's more than I think it's a 1 or 1.5 inch like gap between a curb and basically the concrete, where like maybe the concrete sunk down a little bit, they make you go ahead and replace that and repair it. So there's a bunch of little things like that spread out across the site that, part of this recapitalization will knock all this stuff out.
Yeah, and that's held at the lender. We draw that back from them as we get stuff completed. We don't get to really negotiate on how much they think it costs, but we get to draw based on what we actually spend. A lot of these things we can do in-house, so that saves on some of that cost. But also we can get a lot of this stuff done pretty easily. The last part we have here is our reserves. So we go through our reserve strategy, taxes, insurance, our capital improvements, and for the end of the third quarter, that number is $481,000 on this deal. So we hold that going into Q3. So we'll be fully funded on all our reserves from third quarter. We have our improvement holdback, and then we'll still have almost $4.9 million that will be dispersed. We plan to make those disbursements early next week. There is a holiday on Monday, so stuff won't go out on Monday, but it'll be middle of next week that we're going to have the next chunk of cash that goes out. So you'll receive. Well, they receive 3 payments now. There are 2 payments. 2. So you'll get one on Friday, which is return of capital and prefs, and you'll get another one, which is the profits that are going in. So we think that's a huge win. That's a lot of cash that's coming out.
Yeah,
So
I mean, from our basis to today's value is roughly 3x of total value creation on an equity multiple standpoint, and just the equity standpoint, by the time this is all done, there's gonna be no equity left in the deal that we.
no cash, no cash. Yeah.
And then really all we have is that future upside. So we're excited, and we're excited about our performance. We're excited about where the market is done. We're excited about Gainesville and being in Gainesville, which has had a tremendous performance from when we bought it, and be able to stay in Gainesville with this property in this position.
Yeah. So we're sending out basically $2 million on Friday and $5 million next week. And even after doing that, we're going to look at what this deal looks like going forwards and why we were excited to hold it. So this is kind of our pre-refi cash flow and post-refi cash flow. So if we just assume our same net operating income of $890,000 for a year, you can see our interest here post-refi, the loan's 2.5 times as big. So interest is a lot higher, but we have 2 years of interest only. So we're paying no principal payment. And therefore, our cash flows for the next 2 years are just below what they were with the previous loan. So if we have, if you invested $50,000, you're getting all that money back. But even going forwards, you're still going to earn about $4,800 a year on that $50,000 investment. So our available cash flow is just over 300 grand, even post refi. Now you're going to ask, like, hey, what happens when we start paying principal? We've had the past 2 years, we've had 6 to 7% rental growth a year, which is just over 100 grand. Once principal kicks in, we're going to owe, that'll take our payment up another $250,000 principal each year. But we're optimistic that if rent growth keeps going how it's been going, we're going to be able to earn that up and be able to make those principal payments too. So we feel very optimistic about future cash flows as well coming out of this deal.
And even with that all said, even if they don't, we'll have less available cash to distribute, but we'll still have cash to distribute. So more of the point is that we can afford to make principal payments here. We just get a 2-year buffer to really catch up our NOI to cover the principal payments and still have the same cash flow in the future.
Yeah. So overall, we feel like this is a huge win. We're sending back a bunch of cash to all of our investors, and we're going to still be able to generate future cash flows. So it's really the best of both worlds. All the equity's back, profits are pulled out, and we're going to have future cash flow. All right, so we've got a couple opportunities that were coming up as well. We're going to do live streams for these, so we just kind of wanted to let you guys know what's coming up, and we're going to jump into Q&A here. Most of these, we have our Appleby type assets. We have our retail stable cash flow. What we also have is the Midtown Office Park, which is up in Chattanooga. That's a very big project with some government and medical tenants. We have one other government deal that's in West Columbia, and that's this vocational rehab center. And then we have our industrial, our flex deals that are coming up as well. All of these are our cash flow generating deals starting out. So we're excited about these opportunities, and we're kick off some Q&A and see kind of how did we do on explaining the Park Hill refi and what it looks like.
Okay, well, thank you, Dave, and thank you to everyone who submitted questions. We want to remind you that you can continue to use the Q&A feature at the bottom of your screen to submit questions as we work through those that have come in so far. We'll dive right in with some of our review questions. You guys did talk about this, but I think it's good for us to pause and reiterate. So first, can you review the use of proceeds for us one more time?
Yeah, so I will jump back that one, go forwards one more slide. Yeah, so that's this slide of like where did the cash go and where is the cash? So
Can we present that?
we got this coming up here in 1 second. So we look at the uses of cash, and when we closed on Monday, on the balance sheet, we had $858,000. So that was the cash that we already had. And then we added the net cash from the refinance. And to get to that net cash number, we had our $13.2 million loan, pay off the old loan, and then pay off our closing costs. So that's where we get to 7.7 million of current cash on the balance sheet. From that, we're paying out existing equity, preferred returns, and then we basically can't use this $155,000 and $480,000. Like that money is going to stay on the balance sheet. That $155,000 will be used for repairs, so that's essentially held at lender and then eventually going to show up as capital improvements on our balance sheet. The net difference will be a plus or minus cash. And then the remaining cash this is the cash flow that we're talking about sending out next week. That's all profits.
And what is the prepayability of the new loan?
Yes, so it's a step, it basically, well, first of all, it's a Fannie Mae loan that can be assumed. We have, that's not really, it can be assumed, it's just not very commonly done in this market. So that's one point to comment on, but the prepayability is basically it's a 5, 4, 3, 2, 1 step down. So every other year it steps down. So right now the prepay, if we paid it off at the end of this year, it's going to be a 5%. At the end of 2023, it'll drop down to a 4% prepay, and then every 2 years forward, it'll drop down all the way down to 1%. And then the final 6 months of the 10-year window, so 9.5 years, it opens up to a no prepay.
And can you summarize for us again what the capital improvement holdback is for?
So we're holding back $155,000, or the lender's holding back $155,000 for we have a full engineer's report. If you want to see the engineer's report, we're happy to share with you.
But it's all pavement work, curbing, and sidewalk stuff. So it's a big number, and they come up with their price, and it's not really negotiated. Like if they say, hey, this sidewalk repair is going to cost $10,000, that's what they hold back for it. If we do it for $2,000, that's just we were ahead from that. So we don't really get to kind of pick the prices that they're going with for the $155,000 holdback. But we're going to do those as effectively as we can.
Yeah, and the report that they have, if you guys wanted to see it, just feel free to email us. We can send it to you. But it's kind of a picture by picture, site by site item. So it's hundreds of items of a bunch of little things that basically, here's a picture, fix this. And we basically have to take a picture afterwards, we fix it, and then we can submit a draw with a receipt, and they basically release this money back to us.
Yeah. That's a great lead into our next question. When this property was first purchased, I don't think you had a criterium inspection report generated. Did you do a criterium inspection for the refinance?
It doesn't quite work like that. Like Fannie Mae, when we do a refinance with them, like they're doing they're driving that inspection process. When we go buy a new asset, we are using the criterium, which is just a vendor. That's not a type of report. That's a vendor that does the engineering report. We like working with them. So we're doing that on the front end of acquisitions, but Fannie Mae, they're doing their own kind of internal lender, report.
Standard report, yeah. Yeah, we specifically criterium, we interviewed a bunch of engineering companies. Fannie Mae uses a different engineering company, but for the most part, they're all very similar. Criterium has a standard way that they present their information, and they all do. But we thought our business aligned most with Criterium, so that's why we use them kind of going forward. But anything with Fannie and Freddie, they use their specific engineer, which it's the same thing. It just presented a little bit differently.
And what happens to funds not used from the improvement holdback? Do they get released and are they available for use on possible future projects?
Yep. Yeah, I mean, if they hold back 155, we spent 125. They'll give us the 125 once everything is done. They basically just take the remaining funds and we get those. They'll be in our operating account.
Yeah, inside the 155, I believe it's a 25% buffer. So the actual estimated costs, I believe, are like around 115, 120,000 plus a 25% buffer is how we get to 155. So we would expect that there's going to be, we should be within that 125% of cost, and there'll be some left over.
Yeah.
Is the plan to hold the asset for another 5 to 10 years?
Yeah, well, I mean, a prepayment penalty of 1 or 2% we're pretty happy with that. So, but that's at least a 5-year hold. We really like the asset still just because of the future cash flow that it's going to be able to generate. So we're excited about holding it. So yes.
Yeah, the assets that we really looked at selling, like we sold Ridgewood earlier this year, we really saw income start tapering off, and we saw the income growth slow down. And that was really kind of the trigger to say, okay, let's look to sell this asset. And some of the other assets that we're selling that some of you are part of, that's really the trigger, is that if we either see income growth start tapering off or substantial capital improvements that aren't really justified to hold the asset. We didn't see any of these hurdles with this asset. We saw great income growth. We didn't see any substantial capital issues here. So we wanted to continue to hold the asset. It seemed like all of you were aligned with us, so we proceeded with this path.
Our last submitted question, and a good one to end on. Can you review the projected distributions with the new cap structure for us? Just another review.
Yeah, one more. Can we share that slide with them? Yeah, we're pulling it up here. 1 second, we'll go through just what the cash flows of this look like. And this is starting at net operating income. So we're not going through income and expenses. We're just saying, hey, this is where we're at right now. So we're at $890,000 of NOI right now. So we're just saying, we just do what we're currently doing. That's where we have this $462,000 of interest expense compared to the $300,000 that we had previously. And then we have cash flows of $428,000. We're estimating about $100,000 a year in CapEx on the asset. So our available cash is $328,000 at the end of the year.
Well, those are all the questions we have. Again, we want to thank everyone for participating. And of course, we want to thank Josh and Dave for sharing these Park Hill updates with us. As we wrap this up, we'll pitch this back over to Dominique to review our upcoming dates and our live stream schedule.
Thank you, Natalie. And we certainly want to thank our hosts for sharing these Park Hill insights with us. As we wrap this up, this is just a friendly reminder of some of our upcoming dates and distribution timeline that Dave and Josh mentioned. We did close the refinance this past week, and we will be distributing preferred returns and investor return of capital September 3rd. Funds should settle around September 8th. We will distribute the remaining use of proceeds on September 7th, and funds should settle around September 9th. And then on the right, we have our upcoming live stream schedule for you. Really, this is based off of a couple of upcoming investment opportunities. We're still nailing down some details here. So the most immediate ones are Complex and the Vocational Rehabilitation Department. Those are really to be determined, but we will be sure to share those live stream event details with you as soon as possible. All right. Well, this concludes our broadcast. We want to thank you so much for joining us today. This is a friendly reminder that this live stream will be sent via email by the end of the week this week. And we encourage you to check out all of our other upcoming live streams later on this month. Thank you so much for joining us today, and you have a great day.
All right. Thank you very much, everyone.